Josh, great to see you again.
Hey Jim, how's it going?
Good, good. We were talking about the DSCR loans last time,
Yes, we
and
were.
it
Great
it
product.
it opened a whole new world of thinking up to me. And I thought this is great because the average person that watches this video has an opportunity to do something that was totally out of reach, several
So,
years ago.
so what I'd love to go over today is, what are the requirements? What does it look like when we're meeting the key requirements for a DSCR loan,
Yeah.
right? So, we got a lot of we got a lot of things that come up. Number one, credit score.
Okay.
Two, down payment, loan to value, and ratios. And the third item is cash reserves and the requirements of having some cash in the bank, right?
Okay.
So when we're looking at a DSCR loan, when you look at the credit score requirements, we range from anywhere from 620 to 800, right?
Mm,
So the minimum credit score you're going to look at is going to be something like 620, which is limited. You have very limited options, stricter terms, there are prepayment penalties and stuff like that. When we get to the higher credit score, something like 660, 680 or above, the possibilities start increasing. The interest rates start dropping a little bit. You get higher loan to values and much more options on prepayment penalties. When
right.
you get to the great credits, 700, 720 plus, now we're in a range where we're the elite status for DSCR loans, right? And in
Yeah.
this elite status, no prepayment penalties, there's lower fees, there are better interest rates, there are higher loan to value products. There's, much more that we could do. Now, the second part of it, looking at the down payments, right? Let's take a look at what we need to put for a down payment.
Yeah.
Traditionally, a good place to stay is to be around 30% down payment. Now, when you're at 30%, options are about open up all over the place, right? And you're much more open to getting, again, better rates, better loan terms, no prepayment penalties, and just an overall better product, even a 1.0 debt service coverage ratio, which means 1 to 1 for your rental income and your actual mortgage payment can be equal, right?
Okay.
Now, as you start decreasing, the down payment, now you go 20 to 25%. The ratio needs to get a little bit higher to 1.1, 1.2. Then your down payment, you're looking at 20 to 25%, which reduces your ability to negotiate on a prepayment penalty. And then the ratios get a little tighter, so it's a little harder to meet the ratio requirement with a mortgage payment.
Right.
All right. Then if you look, and it's very, very rare, and it's mostly relationship based where they allow for it, a 15% down DSCR loan is generally for a redevelopment type project where the bank knows that you're going to be putting additional funds into it. And the property that you're buying still has actual income attached to it. So you're not buying an empty property, you're buying something with tenants in place, and those tenants are paying a portion of the rental income, but you're looking to increase that rental income through the idea of forced appreciation, which is a whole other topic that we could discuss. All right.
Okay.
The third requirement and most important requirement for a DSCR loan is cash. Banks want to know that you have reserves available. Okay. They want to know that you have at least 3, 6, or even 12 months of mortgage payments available in reserves. So,
Mm,
what does that mean? If your mortgage is $2,500 a month, they're going to want to see at least $15,000 in reserves. So,
okay.
what are we talking about when we say reserves? Reserves are just extra money sitting in a savings account. Not
Okay.
money you need to utilize, nothing like that, but just funds set aside in a savings account. Those are the three main requirements when it comes to a DSCR loan. That's what makes all the difference.
So you would sit down with someone and go over the details, go over the finances, and you're kind of like the person that's, I don't want to call you a coach, but you're the consultant that's going to let the person know whether or not this is going to be a good fit for you or not. Maybe how far away you are from doing it or not doing it.
So, yes, I do that. I'm not supposed to be a financial consultant. I'm not supposed to be a real estate mentor. I'm not supposed to be, a
Yeah.
real estate analyst. But 20 years of experience in real estate, 20 years of experience in real estate finance, I can't help myself but try to make things easier on my clients and friends.
Yeah.
So when you come to me with an idea and you say, "Hey, Josh, I want to buy this property. I'm not sure what direction to go in," I come and I tell you, "Hey, here's here's a financial analysis you can take and do very easily for yourself and decide whether or not this makes financial sense. Again, as an investor, your number one goal is to create guidelines for yourself. If you
Yeah.
have guidelines to follow, you can work like a larger institution and always make money.
Now back in like before 2008, when you could get another loan and if you could fog a mirror. And then all of a
Yes,
sudden the economy turned and everybody lost all their investment income. Not everybody, but a lot of people did.
yes.
This is not that.
This is completely different. This is
And,
completely different.
and if you had to sum it up real fast and say why this isn't that, what would the reasons you give somebody?
The requirements of cash reserves and the requirement for a down payment. All right.
Okay.
That's what makes these products so attractive to lenders specifically. So the lenders reduce their requirements. They make it so easy because it's just a common sense loan. You have
Yeah.
to have equity, you have to have money in the bank, and the property has to pay for itself. These
Right.
are the three main requirements.
Right. And as let's say you were talking to me about what you just said. If I couldn't meet those requirements, I shouldn't be going down that road anyway.
If you can't meet those requirements, I will tell you up front, and you should not be buying real estate.
Yeah.
But my job here is to make sure that you meet those requirements. We look at your overall portfolio. We want to make sure that you're ready to take that step to get the DSCR loan or get the investment property or anything like that, right?
Yeah.
Maybe it's in your best interest as an investment property to buy a single family home, not a 4 unit property. You know,
Right. I got you.
all of the range of ideas comes together with the idea of knowing who your client is, what their financial comfort level is, and how much time that they can invest in this as a new business.
Yeah. Yeah. Well, Josh, I mean, whether a person's a first-time buyer or they're just getting started in real estate investment or want to and they don't know where they fit, either person, I know you're great. You can help either one. How do people find you? Where should they go?
Feel free to check us out online, firstnationfinancialcorp.com. We have we have some free consultations and we have some paid consultations that give you a lot of time to go over properties and assets and income requirements and things like that with me. You can check us out at firstnationfinancialcorp.com or give me a call at 832-955-9255. You can set an appointment with us and one of our very qualified real estate investment analysts and mortgage brokers will be more than happy to help you.
Josh, I'm always learning something new when I talk to you. Thank you. I'm looking forward to the next time.
Absolutely, Jim. You have a great day.
All right, you too.